welcome to this special conversation. This is CNBC TV 18 Prime Playbook. I'm your host, Surabhi Upadhyay, and we are here to kickstart a brand new series. Call it a podcast or a vodcast. Call it a conversation. That's what I call it. And we are here to understand more about the idea of investing, the idea of wealth management, and how the advisory business in India is really coming of age. With me on the show today is Pranab Uniyal, who heads HDFC True, which is HDFC Group's wealth advisory business. Pranav, thank you so much for taking out the time and joining in. You're in the hot seat. Your business is booming. So tell us, how has it been 2025?
Thanks, Surbi, and delighted to be here talking about this business, which, as you said, is doing well. Generally speaking, HNIs or the wealth space in India has been booming, right? It's really a pyramid, right? All the parts of the pyramid are firing, especially so as you were above the at the top end of the pyramid. Now, within wealth, for example, right, there are really two ways in which somebody can really advise you or help you with your wealth management, right? One is the advisory, the other is a distribution, right? And distribution is something that we have known for long. The essential difference is that while in distribution, uh, and everybody has to make money, right? All of us are here to make money from the respective businesses that we do. So in distribution, the wealth manager earns the income from the products that he or she would recommend to you, right? And he or she would not charge a single dime from you, right? In advisory, it is just the opposite, right? Wherein the advisor and by regulation cannot earn a single rupee from any of the products that he or she recommends you. So what that means is then he or the advisor would need to earn income from you, right? Now, as a fallout, if you go with a wealth advisor as against a distributor, you would end up investing into direct schemes. Why? Because of course, if you invest into regular scheme, I as an advisor can't earn anything out of it. So I would rather get your money into direct schemes. Now, naturally, the direct schemes for across all the asset classes, across all the products, the expense ratio is far lower. So from that sense, uh, what advisory is trying to achieve is two things really. One is, and that's what really the regulator had its intention and why this whole thing started. Is one is the conflict of interest, right? So if I don't earn a single rupee from the product that I recommend, then I would be really foolish to recommend you a bad product because you have to pay me advisory fee year on year, right? So I would rather choose something that is good for you. And second thing, which is really a byproduct, really not it's just come out serving the single biggest intention of conflict of interest, but the byproduct is big in itself, is the cost saving, right? Given that you're investing in direct schemes, the advisory mode of wealth management turns out to be far cheaper than the distribution mode of wealth management, right? So advisory as a regulation came in 2013, right? The idea of then and it really started slow, but then really the ecosystem started unfolding from there on, right? So first the advisory regulation came, then the direct schemes for mutual funds came, for PMS came, for AIFs came, right? So and because of that, an advisor could then be having those asset classes to help you.
No, absolutely, and it's been over a decade, but yet the progress has been a little slow, one can say, because we as a nation of investors, first of all, we're just moving from being a nation of savers to a nation of investors. We're not used to paying for advice. We pay for medical advice, we pay for legal advice, but the idea of paying for financial advice still hasn't sunken in. So I just want to sort of tell viewers who are watching as well that if you're largely if you are with mutual fund distributors, they also do a little bit of advisory. They do, but it's very important to keep in mind that at the end of the day, who is paying that quote unquote advisor, whether it is the product manufacturer, the person who's coming up with that fund, or whether it is you, and that therein lies the fundamental difference. So Pranav, tell us, and in your trajectory in financial services, now HDFC True is obviously you're purely looking at advisory, right? This is how it is, and this journey has been on for about 5 odd years. So what are your lessons and learnings so far?
So first of all, let me kind of let's say ensure that I complete the explanation of the first question, and continuing on the second part, let me state that both let's say, modes of wealth management is good for an investor, right? Except that the advisory has got guardrails. It does not mean that just because you're paying a little more to the distribution or to the distributor, it is bad for you, right? Except that possibly within the distribution mode, there could be some fringe elements which may try to actually, not be, not do something which is not good for the end investor. But the guardrails ensure that on this side, the advisory is pure play, right? There is actually nothing left. The regulator is ensured that it is actually not possible to do any hanky panky with the investor.
Yeah. And also the this community of registered investment advisors, RIA as it's called, it's a very small community in India, right? I mean, there are, like, you can probably
It is
count.
crazy. Yeah, yeah. In
What
fact,
are the latest stats? I don't remember them, but it's very small.
I lost track of it because it is continuously going down. It is less than 1,000 probably now. I don't know, 600, 700.
I think so. It's
Honestly,
around 600.
I
Yeah,
lost track.
yeah, yeah.
But and that is what probably there's the next leg of the stuff that regulator will need to do. Now, for example, in advisory, every advisor has to pass 10A, 10B. Okay. Now, I am, with all modesty, I've cracked JEE, I've been IT, I've cracked CAT. But let me tell you, 10A, 10B is not easy, right?
Even for someone who's cleared all these other mega, entrance exams
Right.
like CAT and GEE.
Yeah, so JE cats, right? So let me tell you, 10A 10B is not easy, right? And I have seen people, taking
By the way,
probably
10A, 10B, if you're wondering, 10A, 10B is an examination or certification that you need to clear in order to become a registered investment advisor. And by becoming an RIA, then you can give out independent advice on financial products to people. So just
right. No,
clarifying that 10A,
absolutely,
10B. Yeah.
absolutely, right. So, and I've seen people reappearing for it 3, 4 times, right, and just about barely passing. So those are the and while on one side, of course, it kind of really sets up the bar high for people to appear, and but what SEBI has been doing is it's actually lowering down the bar, right, trying to make the playing field a little level, but not. And of course, there's going to be some difference or the other between the two. But for example, from post graduation consideration, they brought it down to graduation. So to that extent, and again, 10A 10B, you had to appear every 3 years, but now there's a revision test that you can. It's called 10C, that you can go for it. So one thing is for sure, we have seen attempts being made by the regulator to make it easier. And again, the kind of, let's say, compliance that an advisor has to stick to. Every single advisor has to be recorded, and there are audits. There are regulatory as well as internal audits. So you have to store those advisors, etc. So it's a little tough. But then that's really where the wealth management in any country should move towards, right? Because there has to be some kind of accountability for what you are offering to the investor, because ultimately it's serious wealth we are dealing with.
So now coming to the second part of my question, right? Because you guys have been doing this for over 5 years now. I
Yes,
think you're
yes,
just building this business from COVID
yes, yes.
in a country where people don't want to pay for advice, in a country where it's the whole mutual fund distribution model, which is and they've not done bad. They've gotten us to this point. Look at the penetration levels now, right? So you've been doing this for 5 years. What are your lessons and learnings?
So it is a snowballing phenomenon, right? Meaning that I do hear, I do hear still. I heard a lot more than how much I hear now. The fact that investors in India don't want to pay for advice, right? Because we have seen our investors paying for it. Uh, I think it's also a function of ecosystem, right? 5 years back, there were no advisors, right? And to that extent, even the first few advisors that came about, right, were probably the individual advisors, right? And here you were dealing with the well-known institutions, right, who refuse to probably offer advisory yet, right? Because the model, it's a thing of incumbency, right? You want to kind of keep doing what you've been doing. The margins are higher, so why would you want to venture into advisory? And so most advisors that came along were individual advisors. So for a lot of UHNIs, they would rather want to stick with the larger institutions who they've been dealing for the last, let's say, 10 years, 20 years. Now, and that's what happens with most of the things, isn't it? It starts slow. We saw some of the institutions themselves realizing that, look, we have to safeguard our investors. We have to guardrail. Want to ensure that if the investor wants advisory, right, we want to ensure that we offer him advisory rather than him going or her going somewhere else, right? So slowly but surely, these institutions also started to offer advisory to the extent that uh, it's become a function of, if you're acquaintances, right? If the friend who you speak with, during lunchtime, uh, or in a table of seven, when you have your lunch, 5 years back, nobody did advisory, and you wouldn't do advisory either, right? But in that lunchtime conversation, if you realize three are doing already, right, it kind of opens your eye and says, hang on,
Something must be
let me
changing.
understand it a
Yeah.
little more.
Yeah.
Why don't I do it myself? And then I would also want to understand what is the overall cost saving. And then, even if it entails me paying a fees, as long as I can quantify the amount of cost saving that advisor is making for me, why not?
I mean, again, to simplify it for a lot of people who don't track the ins and outs of the mutual fund industry that carefully, the reason why we're talking about savings here is that there is the direct route going into mutual funds where you're not coming via distributor. So therefore, you don't pay the high expense ratios, which otherwise general funds usually have, because there is a cost of selling that product. There's a cost of bringing it to the end investor. So that's how this landscape is. But right now, I'm just trying to understand, do you expect wealth advisory to really keep growing? At what pace? What is the nature of say your clients, and what are you seeing around you in the wealth landscape?
So the market is huge, right? For all of us, the whole wealth management space. And I then speak of wealth management rather than just a distribution advisory. Uh, in India, the HNI AUM is roughly around 100 lakh crore, right? Financial assets are of around 100 lakh crore, of 350 odd lakh crore of the overall financial assets in the country. That 100 lakh crore will become 200 lakh crore in probably 2 to 3 years' time. 100 lakh crore was probably a year back. It would be 120, but that's really the pace of the growth. Typically in India, 15% of these HNI assets are being, let's say, advised. Advised being, by advised, I mean by managed, right? So, as compared to probably 70 to 80% in the mature markets. No, so there really two, or the twin engine moving, isn't it? One is there's the sheer growth in the underlying financial assets, and the other is the market share of professional managed versus DIY. And within that, because of what the reasons that I mentioned earlier, advisory is bigger share of the market within the wealth management, right? So because of the three compounding, it's looking very good as far as advisory is concerned.
So tell us a little more about this pool of investors, savvy investors who are willing to pay for best in class advice. Are they largely HNIs? And what are they looking at? Where are they investing?
Right. So, one of the things that, again, while I talked about conflict of interest, I talked about cost saving. The other essential difference, and I should have pointed it out earlier, is, let's say, the gamut of things that an advisor can do versus a distributor. An advisor is literally that, right? It starts from financial planning,
Yeah.
right? Because uh, before managing your wealth, I should understand what you're looking for, right? Financial planning, right? Goal planning, then figuring out what is the kind of return that you're looking at. How do you achieve that return, right? And then making that long term plan. And only then really fitting the products inside, right? As against a product led approach where you just
New
bring.
NFO in town
Absolutely.
should be
Should
included
be
in your
there.
portfolio.
Absolutely, right? Because if my only interaction with you is when I sell a product, then I'll get a product, right? But if my interaction with you is manage your wealth, then I'm happy doing financial planning and realizing that, look, if everything is working out well, let me come to you after 3 months rather than trying to sell
Why
you a product.
change? Why churn?
Absolutely,
Yeah, yeah,
right?
yeah, yeah.
So, sorry.
So yeah, I know, and that's a very important differentiating feature of advisory, right? That you ultimately pay for advice that you can trust, and not something that suits someone's agenda. And I mean, it's a marketplace, so there will be sales agendas, and it's just bound to happen. It's natural, especially if you're not paying for it, right? Someone has to pay for it. So the question is now, what from here? Where is this advisory market, growing by how much? And in terms of products that you would be sort of advising your clients on, is it the same universe of mutual funds? Is it some other products, exotic products? What's going on?
So, if anything, it's bigger simply because, again, the regulator allows the advisor to talk about various other asset classes and really talk about it. Right now, it's an interesting phenomenon or interesting fact is that because you are, as a distributor, you're selling a product, guess what? You can't advise on it. Now, how do you sell a product without advising? Right? So, except that incidental advice is allowed in mutual funds and stockbroking as well, right? But for most of the products, it's tricky, right? So then, first thing, first immediate thing that an advisor can do is to be able to freely talk about and see the fitment of those products and advise on products, advise on portfolios, and also advise on asset classes which probably are not regulated, fully regulated, like global investing, like trust planning, right? Like unlisted assets, right? So those are the things that again can be covered in the advisory, right? Uh, Advisory, and I think that's part of your earlier question as well. At the moment, the way we see it, right? And of course, there's robo advisory that can be worked on a, let's say, model where it can start with smaller portfolio amounts. But to be honest, for people like us within, let's say, HDFC True, we have realized that at least at this juncture, it does make sense to probably look at HNIs, UHNIs for the model to kind of make sense for us, right? So, given the kind of quality that we want to bring in, the research, the teams that we want to build in, we have realized that it does make sense only at a certain portfolio or a certain income per portfolio kind of a
So is there like
approach.
a minimum entry threshold?
Yeah, so we look
It's
at
not prescribed by
yes,
regulation, but
absolutely.
like I'm
It's
just
not.
understanding for
Yeah,
your
no, no,
business. Yeah.
absolutely. So we look at typically 20 odd crore really for investable assets to start with. And again, that doesn't need to come in overnight, right? Because we do realize that even to move from, let's say, one or let's say a normal scheme to a direct scheme, you need to look at exit loads, tax considerations, etc. So, but that's really kind of direction
That's the
we are
kind of
looking
sum
at.
you want to work with.
Absolutely.
Yeah.
And then
Yeah.
like,
Yeah.
look, this is where we are right now. It is an ever evolving, let's say, marketplace, and there are all kinds of advisors. So, like I said, there are people who are willing to work with far lesser portfolio sizes, to people we know for a fact that who look at 50, 100 crores. But really, that's the kind of range that we are looking at.
And isn't it a competitive landscape as well? Because when I look at the wealth business or wealth management business overall, from individual now whether they're distributors or advisors is an ongoing debate. But from individual level players to most of the banks to foreign banks who want to be in this market, I mean there are so many names. So
I know
so
it's
is it
it's a
very
it's a, it's a
competitive?
hyper competitive world, and I would like to believe that then so it is for every single industry, right? Except that whichever industry you are in, you're constantly complaining about just the evolving competition. It is right. But if you ask me, and that's a bit of a tailwind for us at the moment. Advisory, if I may say, is a whiff of fresh air. It does allow us to have good, fresh conversations with the client, right? Because this model is a little different. Not everybody is into advisory, so it does give us that kind of foot in the door in our client conversations. Of course, our lineage and the kind of quality we bring in, that helps. But yes, it is, and more so because even the institutions, right, the wealth management institutions are now realizing that, look, the margins are ever shrinking, right? I'm from HDFC Securities. HDFC True is part of HDFC Securities, and we have seen the playbook unfolding on the broking side, right? And even wealth management, from where we were, let's say, 20 years back to 10 years back, the reality, and given what the consultation paper on mutual funds as well, the reality is that margins will keep shrinking. So to that extent, I think distribution and advisory will coexist, right? But the truth is that the margins for the investor, and which is really good for the investor, will keep shrinking.
And then there's AI, which is disrupting everything. So I'm wondering, how does a nascent business like wealth advisory continue to grow in an era where an algorithm or a robot or a certain code is doing everything in seconds? You can feed everything. Now I don't think ChatGPT is smart enough to feed into ChatGPT saying, look, what should my portfolio look like? But that's a real risk you're working with as well, isn't it?
Yeah, and it puzzles me as well, right? And it kind of is something staring at us, all of us across the industry. But you're right. And we are just starting up, right? I mean, ChatGPT just came 2-3 years back. Already the leaps that it has taken, and the thing with such things is that it kind of grows on what it is, its capability yesterday, not what it was. So in that sense, it compounds, right? So I think the way wealth will evolve is, and that's really, for example, we kind of keep running the models, we keep trying to prove that this asset allocation, or investing into large cap, why? Because mid and small caps have had their, and all of that, it'll be very difficult to compete with AI in terms of coming out with those conclusions, right? Because you're dealing with
Huge volumes of data
huge trillion
analysis. Yeah,
TVs of
yeah,
data, right?
yeah.
Uh, so one part of wealth management is going to be disrupted, that's for sure, right? The other part on the extreme side is really the investment banking kind, right? Where it's more about relationship, it's more about big deals. What do you I mean, you can only gain or benefit only so much from AI. It's more about transactions, deals, etc., right? So it's really a huge range. But the first part, which is, and that's not only true for, I wouldn't like to claim that that is only for, let's say, discount broking, or let's say low end investment size, to be able to choose the right kind of mutual fund, right? Probably AI will be as good as, let's say, us. Even for large investors, even if I have 100 crores, if I'm going to spread it across mutual funds, AI will probably give me the same kind of results, right? So I think for us, for as a wealth manager, we also have to move up along the curve, figure out where we can compete with AI, and that's really on the relationship manager, the high end.
Maybe the simplicity of it as well, because beyond a point, it also does get complex when you have large sums that need to be moved and invested, and some human intervention and help is always going to be needed, or at least so I believe. Maybe I'm too old. I don't know.
But thankfully, we're a little distance away. But it'll be interesting to see the space.
Yeah, absolutely. Okay. So, Pranab, now I want to come to the market here and now and what this year has meant, because it's been an interesting year. It's been a challenging year. The market has not been generous enough to lift all boats
Right.
by the same measure.
Right.
So, what has happened? How has 2025 been, just in terms of client expectations, whether they were met or not? Markets were flat.
Right. So, I think the clients have also got very patient. Over the last 10-15 years, it's been just a one-way bull market, right? Of course, there are phases when markets haven't done well, but what has done well for the clients is, and they've realized that if they're patient, it pays well in the end, right? So to be honest, we haven't had too many tough conversations with the clients, right? Even though the market hasn't done well, right? And of course, even where we are, I think the opportunity is good, right? With the kind of money flows that keep coming in. We're talking about 30,000 crore every month, the SIP volumes. And even if you extend it, right, just use the same growth path, we're talking about a lakh crore of SIP in by 2030, right? What's really happened is, I think, and we all know that there's a bit of a catch up by other emerging markets, right, vis-a-vis India, and that's where probably India hasn't done too well. So if you look at the last 12-month YTD kind of returns, India has underperformed the emerging markets by anywhere between 15 to 25%, right? And I'm not even talking about the tech-led US markets, right? But there's this reversion to mean there's cyclicality, right? With the India's premium to, let's say, emerging markets, right, coming to the long 10, 20 year average, it's come back to that now. We expect that the FIS money will come back to India. Indian money is anyway going in, the domestic money is anyway getting pumped in. I think the other thing that has happened is, with so much IPOs, so much, let's say, fundraising happening, you talk about lakh crore already. So, and lakh crore is, almost like a 10,000 crore per month is no small amount. If you compare to, I think that you told me the latest monthly numbers are 25,
About
20, 20.
25,000 crores equity numbers. Yeah,
You're
yeah,
talking about 10 by 25 already being absorbed by IPOs, right? So that's not a small amount, right? So, but then again, so a healthy reflection of, the market's ability to actually raise money. So overall, I think, we keep, telling the investors and to kind of keep up, keep the chin up. Look for long-term returns. We expect earnings to be around 13-14% for this year, around the same level next year. So from that sense, we see the markets going up.
So if I talk about for HDFC True right now, the total assets under advisory that you have, I mean, if you can do tell us roughly, what is the size of the book, and within that, what's the breakup? How much of it is, you're advising to be in Indian equities? How much is going, say, in gold? How much is going in global markets? What's the current house breakup?
Sure. So we are at close to 13 to 14,000 crore of assets under advice. Uh, Equity, I would suppose, should be around 3,000 odd crore, 3 to 4,000 odd crore out of that. Rest of it is, to be honest, largely fixed income, because gold, even though people have kind of increased allocation, they haven't really been swift and nimble, right? And it's only now
Yeah.
that people
Did
are selling.
anybody catch this gold rush?
People did. People did.
Really?
Right. People.
Those who
Some
had
people did.
proper
Yeah.
asset allocation to
Yes.
begin with.
Yes.
Only
Absolutely.
they would have caught the best
Absolutely.
of this gold rally, right?
Absolutely. In fact, for
Yeah.
that matter, we came out very strongly with some silver calls, right? And that's we've done twice or thrice in the past, and that's really paid out well for our investors as well. And of course, at these levels, you really have to figure out, tactical. By all means, do what you want, but as an asset allocation, please don't go overboard on gold and silver, right? Because everything in life has a cyclicality, right? So one should not forget that. So be careful about don't try to kind of breach your asset allocation looking for the returns just because gold and silver have given 50% returns. So from that sense, I think
So,
the
so you were
asset
telling me
allocation.
the current sort of breakup of the assets that you
Yeah,
advise
yeah,
on, and also the house call, as
yeah,
in
yeah,
what is it that you're most
yeah,
bullish
yeah,
on
yeah,
overall?
yeah.
Yeah.
And you also talked about the overseas, right?
Yeah,
Yeah, yeah,
exactly.
yeah.
Where overseas equities or overseas investments fit in.
So
Yeah.
in fact, I was looking at the data. The LRS has really shot up, right? You're talking about $2 to $3 billion going out every month as LRS, out of which around 130, $140 million per month. That's roughly around anywhere between 12 to 13,000 crore of investments happening in under investments in debt and equity as LRS,
Oh, okay.
right?
Okay.
There's a lot of money going out of India as well, right? For investments.
So money is
Uh,
going out and it's getting invested in global markets.
Global markets, right?
Okay.
That's done well for the investor. It achieves a couple of things for let's say UHNI families as well. One is about diversification. The other is over long term they've realized that INR depreciates, so they get that incremental return, and they are able to also build up some dollar capital, right? That's the way they see it. So that happened, but again, one cannot go overboard as well, right? Because as a diversification, you should do what is required. Of course, you should look at overseas assets, but just going by the track record, just because they've outperformed India to that
Everybody
extent,
wants Nvidia.
everybody wants Nvidia, right? But people forget that, let's say, for if any reason, I'm not even talking about, let's say, market correction, but even if Nvidia has a time correction, who benefits? It's the Indian stocks.
Yeah, yeah, yeah. So therefore, it's important not to
Yes,
be too overloaded
absolutely.
on that side. So calendar year 2026, what's HDFC True saying? Where to park the money?
So, as against our equity research, True is an asset allocation approach,
Yes,
isn't it?
yes, yes.
So, asset allocation will be dependent on each client's
Correct.
risk appetite, etc. But overall, equities are looking good.
Indian equity?
Indian equities are looking good. Fixed income, one has to be careful, right? Because we have seen a phase, that again, fixed income works in cycles, isn't it? We have seen the rates coming down from up. They will now go up from down, right? So from that sense, and that's our advice to the investors as well. We came out with a paper only 2 days back. We believe that makes sense to be in the 3 to 5 year kind of a range with respect to
In fixed income.
maturity and duration in
Okay,
fixed income.
okay.
So from that sense, try not to get into long-term papers. And again, if you get into too short, let's say it may give you some risk mitigation, but then you have a reinvestment risk, right? Because you're investing 5.5, 5.8%, and then what do you do when that it starts going up, but you don't benefit, right? So from that sense, I think 3 to 5 year is a good period. And other than that, absolutely keep your asset allocation up. Look for ways to diversify. Of course, invest outside India. There are various means. We have a Gift City that has come up very well. There are a lot of products available in Gift City. We offer overseas investments through some partners, through brokerages as well. So
And how much, I mean, in asset allocation, I get you're saying that
Sure.
don't go rush and buy gold, silver now.
Sure.
But otherwise, precious metal is a part of the total wealth pie.
Sure.
I mean, roughly rule of thumb, I mean, what
So
is the house view?
yeah.
Keep
So
it at what?
some people say 5, some people say 10. I think we should be between 5 to 10, depending on which part of the market cycle are you in, right? So probably right now, given what gold and silver have done, if you are at 10, you may want to bring it down to 6-7%.
Take some
Right?
profits.
Yeah,
Yeah.
you should. You should.
Okay. All right. Well, that's only if you were invested in gold, enough invested to begin with, right? Then you'll feel happy and then you can take profits. Finally, Pranav, it's been a great conversation. So, as we are winding up, your one advice to investors for 2026.
Uh, so again, stick to asset allocation, right? Uh, and this really been proven now. A lot of people talk about it. The fact is that alpha comes out of behavioral finance, and no more from let's say at an individual investor level, no more from some fancy mathematics, right? If you can stick through quality stocks, quality funds, through thick and thin, right? If you keep investing through SIPs, that is what is going to get you wealth, rather than trying to
Chase
keep
every
changing the
decimal.
queue. Absolutely, absolutely. We've done some studies, for example. We came out with a recent study on what we call a 1 year return trap, right? So what we did in that study was, we took the last 20 years data, right? And we took, for example, in one mode of investment, every year we picked up the best mutual fund of the last year and kept reinvesting into the best mutual fund, right? That is number one strategy. In the second strategy, you kept investing in the number two of each year, right? And so on, so forth. So there was one strategy where you kept investing in the last mutual fund by performance every single year.
Like the worst performing fund
Like
of the
the
year.
worst
If you
performing,
just keep
right?
investing in that for
Keep
20
investing in that,
years.
right? So for 20 years, right? Now, what came out as results was quite interesting. There's pretty much no difference between investing in the top mutual fund, or for that matter, sixth mutual fund or 10th mutual fund. The
Over a
results were
20-year period.
over a 20 year,
Really?
the results were absolutely random. For that matter, probably, and I mean, of course, I'll have to look back at the exact results, but for example, maybe the 10th mutual fund every single year, which is two from the bottom, would have outperformed the top mutual fund had you been
Of
investing,
every year.
right? So that's really
Yeah.
the maturity that people should kind of bring into their investment style.
Don't chase past returns. Does not work. I think that's a solid note to end this on.
And that's where the role of advisor comes in.
Oh, absolutely. So on that note, thank you very much. Very interesting conversation. Tells us so much more about the way the advisory business is evolving in India and what we as investors need to know, where we need to keep our eye on to ensure that we create long-term wealth. Thank you, Pranav, so much for this conversation. We look forward to more of these in the future. Thank you.